Joining us this morning, Satori Fund founder Dan Niles, who also expects a lot more volatility in the days ahead. Dan, great to have you back. Good morning.
Morning, Carl.
You've been a good seer in recent years, especially in the depths of the pandemic, watching fear levels and making some pretty provocative calls. Where are you right now regarding sentiment and positioning, and where is your mix of long shorts at the moment and cash?
Yeah, so I think this reaction to the Fed is relatively predictable because if you look back over Jerome Powell's history at the Fed, when the stock market has been up at least 1% during one of Powell's meetings, the next day it's down 5 out of 7 times. And if you even think about May, it bounced 3% the day of the Fed meeting, and the next day it went down 3.6%. So this is a pretty predictable pattern. And I think right now the stock market is dealing with the fact that you don't want to fight the Fed, just like you didn't want to fight it for the last 13 years when they were excessively loose. And you don't want to fight the fundamentals because numbers are continuing to come down. So for us, we're still pretty cautious. So we have over, I think, 15% of the fund is sitting in cash. We have a fair bit of longs. But we're balanced that out with a fair bit of shorts. And I think we're still playing for ultimately the market is down 30 to 50% from its peak because multiples still have to go down a lot more before this is all through. Doesn't mean you're not going to get great bear market rallies along the way, but that's the ultimate what you're playing for and what you don't want to lose sight of.
So, all right, let's just take the valuation part. Do we sink below the pandemic low of 14.7 times?
Well, absolutely. Because if you kind of think about it, if you look back over 70 years worth of history, when the CPI is above 5%, the S&P trailing PE is 12 times. If you want to be completely optimistic and assume somehow you get below 3% in the near term, the trailing PE multiple is 15 times. You're at 19. So to get from 19 times to 15 times, you still got to go down 20%. If you want to get back to 12 times, which is the average when it's above 5, and obviously we're above 8 right now, you've got to go down 35%. So, and that's not taking into account the fact that I think the majority of companies are going to have to cut their numbers when they report. Don't forget, Target guided lower 3 weeks after they gave guidance. Microsoft did it 6 weeks after they gave guidance. Intel sort of soft pre-announced 6 weeks after they gave guidance. These are massive companies that are coming out very quickly after they've already guided to cut numbers again. And I think it's going to get worse when you see what Q2 results are for the market in general when all of these companies have to report and guide.